Hey everyone, John Henry here, slingshotfutures.com. Today we're going to be taking a look at wedges, how to trade wedges, what are wedges, the different variations of wedges, and generally my approach to wedges as a whole. Now, if you're not familiar with a wedge is a type of market formation. It's what price does when it creates a, well, I mean, for lack of better words, a wedge, right? If we look at the overall market movement, the way that they look is like a triangle, right? It's just a triangle on its side. But there are a lot of different types of these wedges. So the first type of wedge is an ascending wedge. Now I'm sure you can kind of figure out what that means. It's a wedge with a point that's pointing up. That is an ascending wedge. Now there is also a descending wedge, which again, common sense would say that it's probably pointing down, right? So those are the two common ones, but you do also have a flat wedge, which could also be called a pennant, which is more of just a flat one. And really what we're looking at is the point, right? That's what I'm talking about when I'm saying up, down, nowhere, etc. It's point an arrow from that point. That's where it is. So this is an ascending wedge, this is a descending wedge, this is a flat wedge or a triangle. That's basically what you're looking at when you're talking about these types of wedges. Now, there are a lot of different ways to trade a wedge. One of the most common ways is to trade the breakout, right? So you have price that's moving up, it begins to wedge, and it forms a little bit of consolidation in that formation. And then if we use purple for the price, you're buying the breakout move, right? So price just kind of meandering around inside of here, and then you get this, right? Traders will be looking to buy this breakout right there, assuming that it will continue to at least retest the objective, which would be the highs. Now, that is a very aggressive way to get in because sometimes you'll be buying this breakout maybe even a little bit early before the breakout happens if the context of the market is good. So this is one way to trade that type of move, right? You're buying the breakout and you're anticipating further momentum to the upside. Another way is to wait for the breakout to actually break. Now, what do I mean by that? Well, if we have price again moving up, we have a nice little wedge like this, and we have price meandering around inside of here. You're waiting for the breakout to actually occur. So instead of buying early or right at the breakout point, you're waiting for something like this. If the context is very strong, the market should continue, and you're waiting for that breakout move with confirmation. Whether your confirmation is, a bull candle close outside of it, or maybe two bull candle closes, or whatever your way to get into a market is, you're waiting for a little bit of extra confirmation after that breakout has occurred. Now, there is another way, which is a little bit more conservative and sometimes just doesn't fire off. That tends to be the case when you're looking at more conservative entries, is where it just doesn't happen. And that is going to be the breakout pullback. So again, you have price moving up, you have a wedge, and you have price inside of there. And what you're waiting for is for the market to actually break out and show that it actually succeeded, right? Show that the breakout had some legs to the upside, and then you're looking to jump in on a pullback to retest the wedge. So after it's broken out, it's proven the breakout is successful, you're buying a retest of that breakout point and retesting the wedge and expecting a bounce continuation to the upside. Now again, that type is definitely the most conservative. It doesn't happen as often, but when it does, a lot of traders are definitely watching for those to be in effect, right? So you have three major ways to trade these. Now that we know how to get in, we also have to know how to get out. So the objectives can be split up in a couple different ways. So you have the wedge itself, right? That would be the wedge itself right there, and you're looking for objectives to the upside. Now the first objective is to retest the high of the wedge. That is the easiest objective, the highest probability objective. That's the one that's going to get hit almost every time. Now, of course, almost is the key here because the markets never do anything 100% of the time, so that will fail on occasion. But when you're looking for bigger objectives, now where do you go, right? This is where things can get a little bit interesting because you can actually come down and measure the point of the wedge itself, right? This rally or flagpole, if you will, kind of looks like one of those types of flags you'd find at like a Craig's Cruisers or a go-kart thing. But you're looking for an objective to the upside based off of the distance of here. Right? So you can use an AB equals CD type of drawing. You have A to B equaling the point at the lowest of which it wins. So let's just say price meandered around inside of here, and it looks like this. Right? So you'd be using the measurement of this lowest point. So A to B, right? A to B equals C to D. Right? The same distance on that drawing. So you're basically looking for an AB equals C to D move, and that would be your next objective on the way up. It's a little bit of a bigger target. It doesn't tend to hit as frequently, but that is another objective. Now, a really aggressive objective would be not utilizing this pullback and saying A to B equaling C to D on the peak, right? A full deviation to the upside. Now, I say deviation because you're measuring the overall move and just saying, you know what? I think this is so aggressive that it's going to continue up for another distance up. So you'd be looking for 100% move, this move basically here transposed up. And that would be another way to look for an objective. Now, if you're looking for a slightly more conservative objective, because those are kind of the final targets, right? A more conservative objective would be something like this, where you have a move up, you have the pennant formation, or the wedge, or whatever you want to call it inside of here. We have price that's meandering around in, that looks all nice and fancy, and you have the breakout move. So the next way to measure this up would be looking at the overall move, right? So we have the same move, A to B, but we're only looking for 61.8% deviation up. So that means that instead of going a full 1-to-1, we'll just say the 1-to-1 is up here with dashed lines, right? You're taking the 618 of that move instead. It's a much more conservative target and a little bit more achievable, which means that the probability is slightly increased. Now, could you take all of them? I mean, if you're trading, let's say, you know, a full position size of 1,000 shares or 3 contracts or however you like to trade, you could, I mean, basically look at all of them. They have one there, you've got one there, and you've got one there as a final runner. All of those are totally fine. And that's really kind of what you're looking for. This is a continuation type of pattern. It moves up, consolidates for a little bit, forming the wedge, and it breaks out further. So we can see some examples of this, and there are tons of examples of this throughout the day on pretty much every time frame. Whether you're a faster intraday trader on a tick chart, or you're a zoomed out trader on a daily chart, doesn't really matter. They're all over the place. So we'll take a look at a couple examples here as well. All right, so with any market, of course, the one big thing is that it's never going to look perfect, right? You're not going to have those situations where it's a perfect triangle every single time because it's the markets. I mean, let's be realistic here. That just doesn't happen. But you can see them fairly frequently. So here we have a very nice move to the upside, and you have the pennant or wedge type formation down here. And you can see that if you were to extend these lines far enough, they would eventually cross one another. And that is obviously very wide. It's a very long one, but you get the idea. It's the same thing. This is a wedge. It's a descending wedge after a strong rally to the upside. So where are the 3 different traders? Well, the 3 different traders, you have the breakout buyers right here. You have the after the breakout buyers, which are probably right around there, a couple candles after, and then you have the breakout pullback traders, which were right there. It didn't break out very far, but it quickly pulled back and continued up. All of them had a potential entry on this one. The breakout pullback traders are probably the luckiest because that happens least of the time. But when we're looking for upside objectives, this is where we start measuring it up, right? So you have the A to B equaling the C to D leg, which was a little bit further out. It hit the next day, well, technically the same day in the afternoon. That's when that one hit. You do also have the 618 objective, right? So if you're measuring this up and you're looking for a 618 objective to the upside, let's get our standard fibs on here. Nope, that's not the one I want. I want my standard fibs. You have these 618 traders who are a little bit further out, right, over there, right? You have the 618 traders there. So a lot of things are all stacking up at the same place. Again, you have the deviation traders, which are saying, you know what, I think this is going to go 100% up. That's all the way up here at 67, and that hit the next day at the morning session. So there's a lot of different variations on ways to trade this, and again, they're not all going to look perfect, but you will typically see them in this type of fashion. A nice blow-off move, a consolidation, and continuation. All right, so taking a look at a faster time frame here, here's another example on a wedge. This one right here, nice little move to the upside, and you have the wedge formation right here. Now this one's a little bit of a funky one because the wedge starts here, but I mean, you could also start it here. Those are all fine. And this is one of those instances where you only have 2 of the 3 different types of entry areas that were actually triggered in. You have the breakout buyers, you have the continuation breakout buyers, but the breakout pullback, they never really had a chance. It didn't come down far enough, right? And this is sometimes what happens when you're waiting for the most conservative entry. It just doesn't give it to you. You don't have a chance to actually hit that conservative entry point, and you end up having to deal with something like this where you just miss the trade, and that's fine too. But another great example of a wedge on a very fast time frame. Now again, these will happen on all kinds of different time frames. They'll happen on really fast, really slow, all over the place, just the way that the market moves. So when you're looking at wedges, really the big thing is that it's a continuation pattern. You're looking for at least the highs to retest, if not quite a bit more. It might go a lot further. You never know when it comes to the markets, but that's how you trade a wedge, or at least the most common approaches to the wedge that you can really kind of come across. So that's going to do it for this one. Hopefully you learned something. Hopefully you found it interesting. Hopefully you found it something that you can maybe add to your tool belt if you're not used to trading wedges. Maybe keep an eye on them. They can definitely offer up some pretty nice trading opportunities. Aside from that, though, that's going to do it for this one. If you have any questions, of course, you can send me an email, jbrink@slingshotfutures.com. Make sure to subscribe and click the notification bell icon so you are notified every time we upload a video or go live on YouTube. Outside of that, though, enjoy the rest of the day. Hopefully you had a great trading day, and we will see you all next time.